what makes this environment more unusual is that on the monetary side, there's so much tightening. So if you're in an interest rate sensitive industry, if you're doing commercial real estate, if you're doing residential real estate and you're dependent on volumes and turnover, if you're a small business that has to rely on bank credit for your financing, these areas are struggling greatly.
Financial expert Lyn Alden discusses the current economic landscape marked by a peculiar blend of tight monetary policies and loose fiscal measures. Alden highlights the contrasting impact on various industries, emphasizing the deep recessions faced by interest rate sensitive sectors. She delves into the nuances of the long-term debt cycle, drawing parallels with historical patterns and explaining the two-faced nature of debt bubbles. Alden underscores the intricate relationship between fiscal and monetary policies, pointing out how tight monetary measures contribute to loose fiscal policies. The discussion concludes with a focus on the transfer of debt from the private to the public sector, emphasizing the complex dynamics of the current debt crisis. Let's dive into the video to hear her full thesis.
And many of them are in if you do industry by industry basis, many of them are in deep recessions as it and have been. On the other hand, if you're not very interest rate sensitive and you're on the right side of the very large deficits, you're pretty fine. If you're in the military industrial complex, if you're anywhere kind of near DC, if you're in kind of just a lot of other kind of just real world businesses. And a key example I like to make is that, if you're an upper middle class retiree or near retiree, for example, you've built up a lot of assets, you own your own home, you might have a low fixed rate mortgage attached to it, and you own a lot of, say, money market funds and T-bills and stuff like that. Higher interest rates actually stimulate you because your debt is still fixed, any debt you might have, while now you're actually making more income from your investment. So the government's interest expense is someone else's gain. And that doesn't have the same sort of velocity or propensity to spend that, say, a stimulus check to a kind of working class person would, because they're more, their income and expenses are roughly matched. And so if they get a burst of income, they're likely going to spend it on consumer goods quickly. Whereas if you're wealthier and you get more money, you don't necessarily spend all of it. Some of it might just be saved. However, you're more likely to do international travel. You're more likely to buy luxury goods. You're more likely to help your kids and grandkids. Like if one of them is struggling and they have a wedding coming up, you might chip in. You might help them get their first house. And so that money does enter the economy. It's just in a slower way. And so we're seeing this really sharp divergence between fiscal policy, which is very loose, and then monetary policy, which is pretty tight. And then ironically, the tight monetary policy feeds into the loose fiscal policy by blowing out the interest expense of the government. And so if I take a step back, the long-term debt cycle is fascinating. And that's part of what I started studying aggressively after 2017 to figure out how this normally works. Because if you go back and look at the prior major long-term debt cycle in the US and much of the developed world, which would be the 1930s and 40s, these debt bubbles tend to happen with a 1-2 punch. So first, you get decades of private sector debt accumulation, very, very high leverage ratios. And eventually, when interest rates hit zero, when that's still not enough, it all blows up. And that's generally a disinflationary environment because credit is being defaulted on, which destroys part of the broad money. Banks are failing. That's a very disinflationary environment. But what happens is that becomes intolerable to people. And they basically, there's like this rising populism, and kind of everybody focuses on what to do about the pop bubble. No one focuses on why the bubble was caused in the first place. But the end result is that they end up basically printing a lot of money. A lot of that debt eventually gets transferred to the public sector, right? So there's bank recapitalizations, there's stimulus programs, there's decreased tax revenue from so much economic kind of stagnation, while expenses are still often relatively fixed or increasing. And so a lot of that debt doesn't deleverage nominally as much as you'd expect, and a lot of it gets transferred onto the public sector.
In this continuation, Lyn Alden delves into the aftermath of the 2008 crisis, highlighting the shift from a disinflationary private sector debt bubble to a potentially inflationary sovereign debt bubble. She discusses the challenges posed by the demographic shift as baby boomers retire, impacting Social Security, Medicare, and overall consumption. Alden explains the fiscal spiral the United States faces with rising interest expenses on large deficits. Despite structural issues, the global demand for the U.S. dollar, fueled by its reserve currency status, creates a complex dynamic. Alden explores the delicate balance between the U.S. fiscal challenges and the world's reliance on the dollar, emphasizing the powerful influence of network effects.
And a decade or two later, when the public sector is over leveraged, that's a very different environment. That tends to be more inflationary environment because whenever they kind of run into an inflation problem, the normal approach by a central bank is to raise interest rates. But if there's so much public debt, that actually blows out their interest expense even more. And it increases fiscal deficits, which can be stimulatory and inflationary. And so that's the environment that we find ourselves in, which is that, the whole 2008 crisis and the decade that followed was the disinflationary private sector debt bubble. And a lot of that debt was transferred to the public sector in terms of bank recapitalizations and stimulus programs and hurt tax revenue and all that kind of thing. And now we have a demographics issue. So the baby boomers are retiring, and so they're consuming and not producing as much anymore. And so that's a strain on the system, both in terms of Social Security, Medicare, and just overall consumption relative to workers to produce them, unless or until technology can fill that gap. And so basically a sovereign debt bubble, as it starts to become untenable, starts to actually be inflationary. And the kind of the way to think about that is, in the United States, the past 40 years saw higher and higher debt as a percentage of GDP and lower interest rates. And that combination actually kept interest expense pretty static, especially relative to percent of GDP. And so the problem is when you hit zero, and then you start going sideways or up in terms of interest rates, while the debt as a percentage of GDP is still increasing and there's still very large deficits, that's when you start to run into a fiscal spiral because you're paying higher interest expense on your large debt and deficits. And that's where the United States finds itself. The United States also has a trade deficit structurally. And so you have very large twin deficits, double-digit percent of GDP twin deficits, which are kind of recipe for a problem. Now, that's offset by the fact that the U.S. is the global reserve currency. And so by default, central banks around the world hold the currency. Like I said, Egyptians on the gray market will go buy dollars as though they're buying like marijuana. That's kind of and they're not buying, Chinese yuan. They're not buying Indian rupees. They're specifically they're not buying Canadian dollars. There's a very strong network effect around the dollar. A little bit in that region, a little bit the euro, a little bit in say the UAE's currency, but mostly the dollar. And so you have that kind of there's that global demand. There's also something like $13 trillion in official BIS estimated dollar-denominated debt, which is all basically inflexible demand for dollars. Servicing that debt, any hope of paying that debt back is all demand for dollars globally. And so there's this kind of like tug of war between the United States running this big fiscal kind of train wreck while there's still demand for its currency, and then the rest of the world kind of slowly trying to get off of that, with the caveat that network effects are very powerful, right? If we all agree that we don't want to be on Twitter or X anymore, we want to go build this other system. It's hard to have that happen in critical mass.
In conclusion, Lyn Alden provides a comprehensive overview of the current economic landscape, emphasizing the unique challenges posed by a combination of tight monetary policies and loose fiscal measures. From the impact on interest rate-sensitive industries to the dynamics of a shifting debt cycle, Alden navigates through the intricacies of the financial world. As we reflect on the insights shared today, it's crucial to recognize the divergent effects on different sectors and the potential inflationary risks associated with the sovereign debt bubble. The interplay between fiscal policies, monetary measures, and global currency dynamics creates a complex scenario, with the U.S. facing a fiscal spiral amidst its status as the global reserve currency. We hope you found this analysis enlightening and thought-provoking. If you enjoyed today's discussion, don't forget to subscribe to our channel hit the like button and share your thoughts in the comments below.